7 indicators every DeFi investor should know. Nowadays, people are investing their assets in crypto industry. All projects are blockchain-based. Most of the projects are based on Ethereum and Tron blockchain. Ethereum introduced the DeFi with which transactions are getting secure and easy. People should know about new technologies they are going to use in coming time. There are tremendous aspects to measure the DeFi performance. Therefore, here are some points which can help you understand DeFi and can make you move forward with more indicators. Total value locked, TVL. TVL is the total amount of value locked in a DeFi system. We can also that it is the total liquidity in the liquidity pools of a given marketplace. Basically, it gives you the view of overall interest of investors in that DeFi project. TVL can help to compare the market share of different DeFi protocols. Price to sale ratio. The price to sales ratio, otherwise known as the P/S ratio, is the indicator that must be considered whether you are a trader or investor. It allows you to compare income with the market capitalization price. This ratio is used to know if a stock is overvalued or undervalued. It is almost the same as looking at income to the ratio of shares. Token supply on exchanges. Large traders and whales prefer not to store tokens in wallets, but to use them. So if the supply of a certain asset suddenly increased in the market, then knowledgeable people are going to get rid of it. Not without reason. When large sellers want to sell their tokens, they usually use centralized exchanges to do so, because they have more liquidity and speed of work. Recently trends indicate that large whales are gradually increasing their interest in decentralized exchanges. Change in token balance. Keeping track of receipts is one thing, and tracking the dynamics of these receipts is quite another. From the previous indicator, it is already decided that keeping an eye out on token supply can be very beneficial. Observing the latest changes in those balances can also be very useful. Changes in large token balances can often indicate or signal an increase in trend or volatility. Number of unique addresses. The more unique addresses and wallets associated with a particular coin, the wider its use and the more users are to some extent interested in it. But this indicator only at first glance reflects the real interest of the community. Non-speculative usage. Understanding what a particular token can actually be used for determines its true value. This can be estimated if you look at the number of transactions made not for the purpose of speculation. It's complicated. Therefore, to begin with, it is worth taking a closer look at OTC transactions. This is what shows whether people are actually using the token or not. Inflation rate. A small supply of tokens does not at all protect them from future depreciation, especially if new releases are planned. That is why, for example, the release of new bitcoins decreases over time. This provides an ever-decreasing inflation rate that should prevent cryptocurrency from depreciating in the future. This is not to suggest that all systems should imitate Bitcoin's scarcity. In fact, inflation on its own is not always bad, but frequent inflation, on the other hand, tends to reduce the value of assets. If you know about cryptocurrency trading, you will notice that most of the listed indicators are also used for fundamental analysis of traditional cryptocurrencies. To make the right choice, whether to invest in a particular project, only your own careful analysis will help.